Before we begin, a quick and important disclaimer. The information presented in this video is for educational and informational purposes only. I am not a licensed financial advisor, mortgage broker, or real estate professional. This presentation is not intended to be a substitute for professional financial, legal, or tax advice. Buying a home is one of the most significant financial decisions you'll ever make, so please, always consult with qualified and licensed professionals before taking any action. Think of this series as your ultimate study guide, but your certified pro is the one who will help you ace the final exam. Picture this: you've spent months, maybe even years, scrolling through listings. You've driven through neighborhoods on a Sunday afternoon, pointing out your favorites. And then you find it. The one. It has the backyard for the dog, the extra room for a home office, the kitchen that makes you want to actually learn how to cook. Your heart is pounding. This isn't just a house. It's the next chapter of your life. You rush to fill out the mortgage application online, a mix of excitement and anxiety swirling in your stomach. You hit submit and you wait. And then you get the email, or the call. It starts with, "We appreciate your interest, but at this time," and your world just sinks. That feeling of rejection, of having the door to your future slammed shut, is absolutely devastating. And what's worse, for a huge number of people it was completely avoidable. The mortgage application isn't just a form. It's the final boss battle between you and your dream home. It's an opaque, intimidating, and often confusing process designed by banks for banks. It's filled with jargon, hidden tripwires, and unwritten rules that can disqualify even hardworking, responsible people. But that ends today, right here. The purpose of this series is to pull back the curtain and demystify every single step of the United States mortgage application. We are going to decode the entire process from the first piece of paper to the moment you get the keys in your hand. By the time we're done, you won't just be filling out a form. You will be strategically presenting yourself as the ideal candidate a lender is desperate to approve. You will understand what they're looking for, why they're asking for it, and how to navigate the system with total confidence. This isn't about just getting a mortgage. It's about getting the best possible mortgage and taking control of your financial future. So, where do we even begin this journey? We start before you even look at a single house. We start with the single most important step that 90% of first-time buyers get wrong. We start with the pre-approval. Think of the mortgage process like a Broadway show. The final application after you have a signed contract on a house is opening night. Everything has to be perfect. The pre-approval? That's the dress rehearsal. It's your chance to figure out the script, fix any problems with your costume, and prove to the director, in this case the lender, that you are ready for the main event. Walking into an open house or contacting a real estate agent without a pre-approval letter is like walking onto a car lot and telling the salesperson, "I want to buy a car, but I have no idea how much money I have, or if a bank will even give me a loan." You will not be taken seriously. In today's competitive housing market, a pre-approval letter is not optional. It's your ticket to the game. It proves to sellers that you are a serious, qualified buyer who can actually close the deal. It transforms you from a window shopper into a power buyer. So what exactly is a pre-approval? It's a conditional commitment from a lender stating that they are willing to lend you a specific amount of money to buy a home, based on a preliminary review of your financial situation. It's the lender saying, "Okay, based on what we see right now, you look like a good bet. We're willing to back you up to, say, $400,000. To get this letter, you're going to have to provide the lender with your first batch of documents. This is where people get nervous, but don't be. It's all about being organized. Typically, you'll need your most recent pay stubs, the last 2 years of your W-2s or tax returns, and the last couple of months of your bank statements for all of your accounts. The lender will use this information to perform a deep dive into your financial DNA. They are essentially trying to answer 3 core questions. Think of these as the 3 pillars of mortgage approval. 1. Do you pay your bills on time? 2. Can you actually afford the monthly payment? And 3. Do you have any skin in the game? Let's break those down. The first pillar is your credit. This is your financial report card. The lender will pull your credit report and, most importantly, your FICO score. This 3-digit number, typically ranging from 300 to 850, is a snapshot of your creditworthiness. Tells a lender at a glance how risky you are. A high score says you have a long history of responsibly managing debt. A low score flashes a warning sign. While you can technically get a mortgage with a lower score, the best interest rates, the ones that will save you tens of thousands of dollars over the life of the loan, are reserved for those with high scores. Your credit score is the foundation upon which your entire application is built. It's a measure of trust. The second pillar is your income and your ability to handle debt. Lenders don't just care about how much you make. They care about how much you owe. They measure this using a critical metric called the debt-to-income ratio, or DTI. This is one of the most important numbers in your entire application. It's calculated by taking all of your monthly debt payments, things like your car loan, student loans, credit card minimum payments, and dividing that by your gross monthly income before taxes. Let's use a simple example. Say you make $6,000 a month before taxes. And let's say your monthly debts add up to $600 for a car loan, $400 for student loans, and $200 in credit card payments. Your total monthly debt is $1,200. You divide that $1,200 by your $6,000 income, and you get 0.20 or a DTI of 20%. Now, the lender will add your proposed new mortgage payment to that debt pile. If your new house payment is, say, $1,800, your new total monthly debt becomes $3,000. Now, $3,000 divided by your $6,000 income is 50%. Most lenders have a hard cap on DTI, often around 43% to 45%. In this scenario, you'd likely be denied. This DTI calculation is the mathematical gatekeeper that determines how much house you can actually afford in the eyes of the bank. The third and final pillar is your assets. This is the cash you have on hand. The lender needs to see that you have enough money for two things: the down payment and the closing costs. But they also want to see that you have reserves, what I call the emergency fund. They want to know that after you've paid your down payment and all the fees, you won't have a bank account with $0 in it. What if the water heater breaks the first month you move in? Having reserves, typically a few months' worth of mortgage payments stashed away, shows the lender that you are financially stable and not living on the edge. It proves you have skin in the game and that you're prepared for the responsibilities of homeownership. Credit, income, and assets. Those are the big three. During the pre-approval, the lender is doing a quick check on all three pillars to give you that conditional yes. It's your green light to start seriously shopping. You now have a concrete budget, you know how much you can afford, and you have a letter in your hand that makes you a legitimate player in the real estate market. Getting that pre-approval letter feels like a massive victory. And it is. It's the first major hurdle you've cleared. But I need you to understand something critical. The pre-approval is just the beginning. It's the ticket to the show, not the final curtain call. The real scrutiny, the fine-tooth comb, comes later. The information you provide now sets the stage for everything that follows. Any inconsistencies, any red flags, any sudden changes in your financial picture between now and closing can completely derail the entire process. So now you have this powerful letter. You're ready to go find that dream house. But what happens next? What happens when you find it, you make an offer, and it's accepted? That's when the real work begins. That's when we move from the dress rehearsal to opening night. And in the next part of this series, we're going to dive into the official application itself, the dreaded Form 1003. We'll break down every single line, every box, and I'll reveal the single biggest mistake people make in the employment history section that can instantly kill their chances of approval. You've cleared the first gate. Now it's time to prepare for the next. All right, let's dive straight into the belly of the beast. The employment and income section. If the first part of the application was the handshake, this is the job interview. This is where the lender stops asking who you are and starts asking why they should trust you with hundreds of thousands of dollars. They are trying to answer one fundamental question. Is your income stable, reliable, and likely to continue? Think of it this way, to a lender, your job isn't just a job. It's the primary asset backing their massive investment in you. They need to believe in it as much as you do. So let's start with the basics. Employer name, address, phone number. This seems simple, almost insulting to even mention. But you'd be shocked how many people create an instant red flag right here. You must use the full, legal name of your company. Not the Corner Bistro, but Corner Bistro LLC. Not St. Mary's, but St. Mary's Regional Medical Center. Why? Because when they run a verification, they need to find the exact legal entity that signs your paychecks. Any discrepancy, however small, forces the underwriter to stop, investigate, and start looking at your file with a magnifying glass. You don't want that. Match it perfectly to your pay stub and your W-2. Next up, years on job and years in profession. These two little boxes tell a huge story. Lenders live and breathe by a simple unwritten rule. The 2-year history. They want to see a stable 2-year track record of employment, preferably with the same employer. This demonstrates reliability. It shows you're not a flight risk, that your income source is solid. But what if you just switched jobs 3 months ago? Does that kill your application? Not necessarily. This is where years in profession becomes your saving grace. If you were an accountant at firm A for 5 years and you just moved to firm B as an accountant 3 months ago, you're fine. You have 5 years and 3 months in your profession. The underwriter sees a logical career progression, maybe for a better salary or title. That's a positive. But if you were an accountant for 5 years and 3 months ago you decided to become a landscape architect, that's a major red flag. Your entire income stream has changed. The proven 2-year track record is broken. In that scenario, the lender will likely want to see you in that new role for at least 6 months, maybe even a full year or 2 to reestablish a pattern of stable income. So, if you're thinking of a major career change, do it after you close on your house, not before. Now for the big one. The number that this entire section revolves around. Gross monthly income. First, let's be crystal clear. Gross, not net. Gross income is your salary before a single penny is taken out for taxes, health insurance, your 401k, or that weekly bagel fund. It's the big number at the top of your pay stub, not the smaller number that actually hits your bank account. Using your net income is an instant way to underqualify yourself. But how you calculate this number depends entirely on how you get paid. If you're a salaried employee, it's simple. Take your annual salary, say $60,000, and divide it by 12. Your gross monthly income is $5,000. Easy. But if you're paid hourly, you have to do a little more math and you have to be precise. You take your hourly rate, let's say $25 an hour. You multiply that by the number of hours you work per week. Let's say it's a standard 40. That's $1,000 a week. Then, you multiply that by 52 weeks in a year, which gives you $52,000 annually. Finally, you divide that number by 12. Your gross monthly income is $4,333. Do not just multiply your weekly pay by 4. Some months have more than 4 weeks, and that small difference can change your qualification amount. The formula is hourly rate times hours per week times 52 divided by 12. Write that down. Now what about variable income? Things like overtime, bonuses, or commissions. This is where people get into trouble because they assume all of it counts. Doesn't, at least not right away. A lender sees variable income as, well, variable. It's not guaranteed. To count it, they need to see a history. Again, that magical 2-year number appears. They will typically ask for your last 2 years of W-2s and your year-to-date pay stubs to calculate a 2-year average. If you got a massive $10,000 bonus last year but nothing the year before, they won't just add $10,000 to your annual income. They'll average it. 10,000 plus 0 divided by 2 years. They will only count $5,000 of that bonus income. They are always looking for the most conservative, most repeatable pattern of income. If your overtime is inconsistent, they may not count it at all. And this brings us to the single biggest mistake people make on this section. It's not a typo. It's not miscalculating their income. It's the sin of omission. It's the gap. The unexplained gap in employment history. Maybe you took 6 months off to travel. Maybe you were laid off and it took you a while to find a new job. Maybe you were caring for a sick family member. In your mind, it's a perfectly normal part of life. To an underwriter, an unexplained 6-month gap on your application is a black hole. It screams instability and risk. Their minds immediately go to the worst-case scenario. This person can't hold a job. And the absolute worst thing you can do is try to hide it. Stretching the dates of your previous job to meet the end date of your last one is fraud. It's easily verifiable with a single phone call, and it will get your application instantly denied. So what do? You get ahead of it. You face it head-on with something called a letter of explanation or LOX. You type up a simple, concise letter that says, "To whom it may concern, regarding the gap in my employment history from June 2022 to December 2022, I was traveling abroad after leaving my previous position. I have since been employed full-time in the same industry since January 2023, as documented." That's it. You've acknowledged the gap, given a brief, reasonable explanation, and pointed them back to your current stability. You have controlled the narrative. By being proactive and honest, you turn a giant red flag into a minor footnote. Ignoring it, however, lets the underwriter's imagination run wild. And that is a battle you will never win. Finally, what if your situation is more complex? What if you're a recent graduate? Lenders will often accept your school transcripts in lieu of a 2-year work history, provided you're now employed in the field you studied. Your degree is the proof of your 2-year training for the profession. If you have multiple part-time jobs, they'll want to see a 2-year history for each of them to count the income. And if you're self-employed or a contractor who receives a 1099 instead of a W-2, that's a completely different world. The lender will disregard this entire section and instead want to see your last 2 years of tax returns, profit and loss statements, and they will analyze your business's health as if it were a separate person. We'll dedicate a whole future part of this series to the self-employed application because it is its own unique challenge. So as you fill out this section, remember the 2 golden rules: consistency and stability. Make sure your titles, dates, and income are perfectly consistent with your documentation. And present your history in a way that demonstrates a stable, reliable pattern. You have now proven you're a stable earner with a verifiable history. You've shown the lender that the well of money they're relying on is deep and unlikely to run dry. But now you have to prove you have the cash on hand. In the next section, we're going to follow the money trail. We'll dissect your bank accounts, your investments, and I'll show you the one type of deposit that can get your entire application thrown out, no questions asked. It's called source and seasoning, and 90% of homebuyers have no idea what it means or how it can sabotage their dream. So let's talk about source and seasoning. When an underwriter picks up your file, they transform into a financial detective. Their job is to verify every single number you've put on your application, and nowhere is their magnifying glass more focused than on your assets. This is the part of the process called asset verification. It's not just about proving you have the money for a down payment. It's about proving that the money is legitimately yours, that it's stable, and that it didn't just magically appear yesterday. To do this, they're going to ask for, at a minimum, your last 2 months of bank statements for every single account you plan to use for the transaction. Checking, savings, money market accounts, you name it. And they will scrutinize every single page. Yes, even the blank ones. They need the complete, unaltered document from your bank to ensure nothing is hidden. They are looking for 3 things: consistency, red flags, and the origin story of your down payment. First, consistency. They want to see a pattern of responsible financial behavior. Are your balances generally stable or increasing over time? Or are they on a wild roller coaster ride, swinging from $10,000 to $10 every other week? They're looking for stability because stability suggests you can handle a fixed monthly mortgage payment. A major red flag here is an overdraft fee, or what's called an NSF, a non-sufficient funds charge. To an underwriter, an overdraft fee isn't just a $35 mistake. It's a giant flashing neon sign that says, "This person can't manage their money." It suggests you live so close to the edge financially that you can't cover your existing smaller expenses. How, they wonder, can you possibly be trusted with a massive 30-year mortgage payment? 1 or 2 overdrafts in a year might be explainable with a good letter of explanation, but a consistent pattern of them can absolutely get your loan denied. It fundamentally undermines the story you're trying to tell, the story of a reliable, creditworthy borrower. Second, they're looking for any unusual withdrawal patterns. Are you suddenly pulling out large, even sums of cash? Are there regular payments going out to an individual or an entity that you haven't listed as a debt on your application? This could signal an undisclosed loan, like a private loan from a family member or a hard money loan, which needs to be factored into your debt-to-income ratio. They're looking for financial obligations you might have conveniently forgotten to mention. But the single most important thing they are looking for, the one that causes more delays and denials than almost anything else, is large, unexplainable deposits. This is the heart of source and seasoning. Let's define our terms. Seasoning refers to how long money has been sitting in your account. The industry standard is 60 days. Lenders want to see that your funds are seasoned, meaning they've been in your possession and under your control for at least 2 full bank statement cycles. Why? Because money that has been in your account for over 60 days is generally considered your money. No questions asked. The bank assumes it's from your normal income, savings, or other legitimate sources that have had plenty of time to mature. Source, on the other hand, refers to where the money came from. For any large deposit that has not been seasoned, meaning it showed up within the last 60 days, you must be able to document its source. And when I say document, I mean provide an ironclad paper trail that a detective would approve of. So what counts as a large deposit? There's no single dollar amount. The rule of thumb is any single, non-payroll deposit that exceeds 50% of your total monthly qualifying income. So, if you make $6,000 a month, any deposit over $3,000 that isn't from your employer is going to get flagged. The underwriter will stop their review, issue a condition, and your loan process will grind to a halt until you can prove, without a shadow of a doubt, where that money came from. Let's run through some scenarios. Let's say you sold your old car for $5,000 to help with the down payment. Great. You'll need to provide a copy of the bill of sale, a copy of the check from the buyer, and a copy of the title transfer. You have to connect the dots for the underwriter. What if your parents gave you $20,000 as a gift? Amazing. But you can't just deposit the check. You'll need a signed gift letter, a specific document where your parents state the money is a true gift and not a loan that needs to be repaid. The lender will also need to see the money leaving your parents' bank account and entering yours, requiring a copy of their bank statement showing the withdrawal. Yes, it feels intrusive, but it's all part of proving the source. What if you sold some stocks? You'll need the brokerage statement showing the sale of the securities and the transfer of the funds from the brokerage account into your bank account. Every step must be documented. Now we get to the deposit that can kill your entire deal. The one type of money that has no source. No paper trail. The money that underwriters are trained to see as the ultimate red flag. Cash. Specifically, what the industry calls mattress money. It's the cash you've been saving in a safe at home. It's the money you got from a side hustle where you were paid under the table. It's the $10,000 your uncle gave you in a shoebox at a family barbecue. Let's say you walk into your bank and deposit $10,000 in cash. A few days later, that deposit shows up on your bank statement. To you, this is your hard-earned savings. To an underwriter, this is a 5-alarm fire. Why? 2 massive reasons. First, and most importantly, it's a potential violation of federal anti-money laundering laws. The Patriot Act and the Bank Secrecy Act require financial institutions to identify and report suspicious activity to prevent financing of illegal operations. A large undocumented cash deposit is the #1 definition of suspicious activity. Lenders cannot touch those funds. They face enormous fines and legal jeopardy if they use unsourced cash to fund a loan. They would rather deny your application instantly than risk a federal audit. Second, even if they could legally accept it, it tells them a terrible story about you as a borrower. It says you don't use the banking system, which they see as unstable. It also implies that you weren't able to save this money through normal verifiable means. If you had to save cash in a shoebox, it suggests your regular income isn't enough to build savings, which directly contradicts the idea that you can afford a mortgage. So what do you do if you have a significant amount of cash you want to use? The answer is simple, but it requires planning. You must get that money into your bank account and let it season. You need to deposit it at least 61 days, I'd even say a full 90 days to be safe, before you even think about applying for a mortgage. Once that money has sat through 2 full statement cycles, it becomes part of your seasoned funds. It's now considered your money, and the lender won't ask about that specific deposit because it happened before the 60-day look-back period they're concerned with. You've effectively laundered it, in the legal sense of the word, by giving it time to become part of your established financial history. This source and seasoning rule is a silent killer of mortgage applications. People get their offer accepted on a house, they're excited, they deposit their life savings in cash, and 2 weeks later they get a call from their loan officer with the bad news that the underwriter has rejected the funds, and they no longer have enough money to close the deal. It's heartbreaking, and it's entirely avoidable with a little bit of foresight. So you've meticulously documented your assets. You've sourced your large deposits and seasoned your cash. The underwriter is satisfied that you have the money, and it's all legitimate. You've passed the asset verification test. But this is only one side of your financial picture. Proving you have money is half the battle. Now you have to prove that you don't owe too much. We now have to look at the other side of the balance sheet, your liabilities, your debts. This is where we dive deep into your credit report, and the underwriter starts adding up every single student loan, car payment, and credit card balance to calculate that all-important number we mentioned earlier, your debt-to-income ratio. And there's one type of debt that, even if the monthly payment is tiny, can be a sign of extreme financial distress to a lender, causing them to question everything else in your file. That one type of debt is a payday loan, or a title loan, or any kind of short-term, high-interest financing. To an underwriter, seeing one of these on your record is like a doctor seeing a festering wound on a patient who claims to be in perfect health. It doesn't matter if the loan was for $200 and you paid it back in 2 weeks. The very existence of that loan screams that at some point, you were in such a dire cash flow crisis that you couldn't wait for your next paycheck. It signals a level of financial instability that makes them question the foundation of your entire application. It's a massive red flag, and it's one of the few things that can be an almost automatic deal killer, regardless of your credit score or how much money you have in the bank. This brings us to the next major section of your mortgage application: liabilities and debts. If the assets section was about showing the lender what you have, this section is all about what you owe. It's where you lay all your financial cards on the table face up. The lender's goal here is simple: to create a complete, itemized list of every single monthly payment you are legally obligated to make. Why? Because every one of those payments chips away at the income you have available to pay your new mortgage. This is the raw data that feeds directly into that all-important debt-to-income ratio. Let's be crystal clear. You must disclose everything. Don't think for a second you can just forget to list that one credit card or that old student loan. The lender is going to pull a comprehensive, tri-merge credit report from Equifax, Experian, and TransUnion. They will see it all. Attempting to hide a debt isn't just a bad idea. It's mortgage fraud, and it's the fastest way to get your application stamped with a big, red denied. Honesty isn't the best policy here. It's the only policy. So what exactly do you need to list? Let's break it down category by category. First up, revolving debts. This is primarily your credit cards. For each card, you'll need to list the creditor, say Chase or American Express, the total balance you owe, and the minimum monthly payment. Now, here's a common point of confusion that trips people up. Let's say you have a Visa card you use for everything, and you pay the balance in full every single month. You might think, well, I don't really have a balance, so I don't need to worry about it. Wrong. The lender pulls your credit report at a specific moment in time. If they pull it the day after your statement closes but before you've made your payment, that statement balance will show up as what you owe. Imagine a couple, Mark and Sarah. They have a card with a $10,000 limit. They put $5,000 worth of expenses on it last month. Their statement just closed, and the $5,000 balance is reported to the credit bureaus. They plan to pay it off in full next week as always, but the lender pulls their credit today. On the application, they have to list that $5,000 balance. The lender will then typically use a standard calculation, often 5% of the balance, or the minimum payment shown on the credit report, to determine the monthly payment for DTI purposes. So even though Mark and Sarah are debt-free in their minds, for that moment in time, the lender sees a monthly payment of $250 that gets added to their debt-to-income ratio. This is why a common piece of advice is to pay down your credit card balances before you apply for a mortgage, to ensure the statement balances reported to the bureaus are as low as possible. Next, we have installment loans. These are loans with a set number of payments and a fixed end date. Think car loans, student loans, and personal loans. Unlike credit cards where the balance can fluctuate, these are predictable. For a car loan, it's simple. You list who you owe, the total remaining balance, and your monthly payment. 150,000 miles on the odometer? Doesn't matter. Paid off next year? Doesn't matter. Today, that $400 a month payment is part of your DTI. Now let's talk about the 800-pound gorilla in the room for millions of Americans: student loans. This is, without a doubt, one of the most complex and frustrating parts of the liability calculation. For decades, if your loans were in deferment, say you were still in school, lenders could often ignore the future payment. Those days are long gone. Today, lenders have to account for it, and how they do it can make or break your approval. If you are on a standard repayment plan, it's easy. Your monthly payment is what it is. But what if you're on an income-based repayment plan, or IBR, where your payment could be very low or even zero? This is where the rules get tricky, and different loan programs have different guidelines. For an FHA loan, for instance, the lender must use 0.5%, 0.5%, of your total outstanding loan balance as your monthly payment, unless you can provide documentation of an even higher payment. Let's put that in perspective. Meet Jessica, a registered nurse with $200,000 in student loan debt. Her income-based repayment plan has her paying just $150 a month. But if she applies for an FHA loan, the lender can't use that $150. They have to take 0.5% of her $200,000 balance, which comes out to a $1,000 monthly payment. That $1,000 figure is what goes into her DTI calculation. That's an $850 difference that could push her DTI well over the approvable limit. Conventional loans, backed by Fannie Mae and Freddie Mac, have slightly more flexible rules. They will often accept the actual payment reported on the credit report, even if it's a low IBR payment, as long as it's not zero. If the payment is zero, they might use that same 0.5% rule or a similar calculation. This is a critical detail. Your choice of loan program and lender can literally change whether your student loan debt disqualifies you or not. Beyond credit cards and installment loans, there are other liabilities you must declare. This includes things like alimony or child support payments. If you are under a court order to pay these, they are a non-negotiable part of your monthly debt. You'll need to provide a copy of the divorce decree or court order, and the lender will verify the payment amount and duration. Then there are things like judgments, liens, or other lawsuits you might be involved in. If someone has a legal judgment against you for money, it must be disclosed and typically must be paid off before or at closing. If you have a payment plan with the IRS for back taxes, that monthly payment is also included in your DTI. But perhaps the most dangerous and commonly overlooked liability is the co-signed loan. This is a trap that has snared countless well-intentioned people. Let's say 5 years ago, your brother needed a car but his credit wasn't great. So you co-signed the loan to help him out. He's a great guy, he's never missed a payment, and you honestly forgot you even signed it. To a mortgage lender, that is not your brother's loan. That is your loan. When they pull your credit report, that $500 a month car payment shows up under your name, and it goes straight into your DTI. You can argue, but I don't pay it. My brother does. The underwriter's response is, prove it. The only way to get a co-signed debt excluded from your DTI is to provide documentation, typically 12 months of canceled checks or bank statements from the primary borrower, proving that they, and only they, have been making every single payment on time for the last year. If your brother paid you in cash and you paid the loan, or if you had to cover the payment even one time in the last 12 months, you're out of luck. That debt is yours in the eyes of the lender. Before you even think about applying for a mortgage, you need to pull your own credit report and look for any accounts you may have co-signed for a friend, a child, or a relative. It could be the one thing that stands between you and an approval. So you've gathered everything. Every credit card, every car loan, your student loans, that furniture you bought on a store credit line. Each line item on this section of the application adds another monthly payment to the debt column. The underwriter will sum it all up, creating a total of your monthly obligations. This total figure represents your baseline financial commitments before you even factor in a mortgage. It's the weight you're already carrying. So we've tallied up everything you own, and we've tallied up everything you owe. But that's only half the equation. The other half, what you earn, is where the real underwriting scrutiny begins. And for millions of Americans who don't get a simple, predictable paycheck every 2 weeks, proving that income is a minefield of documentation traps that can sink an otherwise perfect application. We'll break down exactly how lenders verify every single dollar you claim to make next. So how do they do it? How does a lender transform your application, your claims of income, into a verifiable underwriter-approved number? It's a process of forensic accounting that begins with the most fundamental document of all, your pay stub. If you're a W-2 employee, you'll be asked for your most recent pay stubs, typically covering the last 30 days. But the underwriter isn't just glancing at the net pay. They are dissecting it. They're looking at your year-to-date earnings to see if they align with your stated annual salary. They're analyzing your deductions, heavy 401k contributions, health insurance, child support garnishments, anything that affects your take-home pay. And they are hunting for inconsistencies. Is there a massive one-time bonus on this pay stub? Is there a huge amount of overtime that wasn't there last month? They see these not as extra income, but as red flags of instability. To a lender, stable, predictable base salary is gold. Everything else is suspect until proven otherwise. And the way they prove it is by going back in time. They will demand your W-2 forms for the last 2 years. This is non-negotiable. The W-2 is the official, IRS-sanctioned record of your earnings. It tells the lender what you actually made, not what you think you made. It creates a historical baseline. If your 2022 W-2 shows you made $60,000 and your 2023 W-2 shows you made $62,000, and your current pay stubs support that trajectory, you're in great shape. You've established a pattern of stable, slightly increasing income. But what if you just started a new, higher-paying job 2 months ago? The W-2s won't reflect your new reality. In this case, the lender will require a signed offer letter from your new company, detailing your start date, your position, and your new salary. They will then pair this with your first full 30-day pay stub from that new job to verify the letter's claims. But even with all this paper, they still don't entirely trust you. They have to perform the single most important step in income verification, the VOE, or verification of employment. This isn't just a casual phone call. Your loan officer will send a specific form to your company's human resources department or use a third-party service like the Work Number to get the cold, hard facts directly from the source. And they ask very specific questions. They confirm your start date, your title, and your current salary. But then they ask the killer question, the one that can silently assassinate an entire loan application. What is the probability of continued employment? If your HR representative hesitates or says we can't comment on that, or if there are rumors of layoffs floating around the company, that uncertainty can be enough for an underwriter to hit the brakes. They do this right after you apply, and then, critically, they often do it again just days before you're scheduled to close on the house. They are making sure you didn't quit your job or get fired the week before they hand you hundreds of thousands of dollars. Now that's the easy path for the standard W-2 employee. For the self-employed, the freelancer, the small business owner, welcome to the gauntlet. Verifying your income is a different beast entirely, and it's where countless entrepreneurial dreams of homeownership go to die. For you, pay stubs and W-2s are meaningless. Your Bible, for better or for worse, is your federal tax returns. Lenders will demand a minimum of 2 full years of all schedules. That's your personal 1040, and if you have an S-Corp or an LLC, they'll want your business returns, the 1120S or 1065 as well. They want to see every single page, every single number. And here lies the great paradox, the trap that ensnares so many brilliant business owners. For years, your goal has been to show the IRS that you made as little money as possible. You hired a great accountant. You wrote off everything, the home office, the mileage, the cell phone bill, the business lunches, that new computer. You did everything you could to lower your adjusted gross income and minimize your tax burden. It's smart business. But now, you are walking into a mortgage lender's office and trying to argue the exact opposite. You have to prove that you are an incredible earner who makes a fortune. You cannot have it both ways. The lender does not care about your gross revenue. They don't care if you billed $500,000 last year. They care about one number and one number only, the net income that you claimed, paid taxes on, and can prove on paper. The calculation is brutal. They will typically take the net income from your last 2 tax returns. Let's say you showed a net profit of $80,000 in year 1 and $120,000 in year 2. They will add those together, getting $200,000, and then divide by 24 months. Your qualifying income, in their eyes, is $8,333 a month. That monster year you just had for $120,000? It gets diluted by the weaker year before it. They are looking for a stable 2-year average. If your income declined from year 1 to year 2, that's an even bigger red flag. They may use the lower year's income or deny the loan altogether, fearing your business is on a downward trend. There are some minor concessions. An underwriter will typically add back certain non-cash expenses, like depreciation on equipment or business use of your home, to your net income, which can give you a slight boost. But it rarely makes up for the massive deductions most business owners take. This same principle of historical averaging applies to other, less conventional forms of income. Let's talk about bonuses and overtime. You might have received a life-changing $50,000 bonus last December. You see it as part of your income. The lender sees it as a fluke. In order to count bonus or overtime income, you must have a documented 2-year history of receiving it, and it needs to be consistent. If you got a $50,000 bonus last year but only a $5,000 bonus the year before, they will average the two, or they may discard the outlier $50,000 bonus entirely as an anomaly. They need to believe, based on historical evidence, that this income is stable and likely to continue. The same goes for commission-based salespeople. A 2-year history is mandatory. They will average your earnings over the last 24 months, and if your income is wildly inconsistent, huge one month, zero the next, they may heavily discount it or refuse to use it. What about rental income? You own a duplex and collect $2,000 a month in rent. That's $24,000 a year, right? Not to a lender. They'll look at your Schedule E on your tax return, see the gross rents received, and then they'll start subtracting. They'll subtract the property taxes, the insurance, and any maintenance expenses you claimed. Then they often apply what's called a vacancy factor, typically 25%, off the top. They assume the property will be vacant for a quarter of the year, even if it's been continuously rented for a decade. So that $24,000 in gross rent can quickly become $15,000 or less in the underwriter's calculation. Even income like Social Security, pensions, alimony, or child support can be used, but it comes with strings. You must prove a stable history of receiving it, and you must provide documentation showing it is scheduled to continue for at least 3 more years. A child support agreement for a 17-year-old, for example, won't count because it will end in a year. Ultimately, the entire income verification process boils down to a single, guiding principle for the lender: risk mitigation through documented history. They are not in the business of betting on your potential. They are in the business of confirming your past. Your qualifying income is not the number on your offer letter. It's not your gross sales, and it's not what you hope to make next year. It is the lowest, most conservative, most predictable number they can derive from a 2-year paper trail. So you've navigated the income minefield. You've proven, on paper, that you have a stable, sufficient stream of money coming in to cover the monthly payment. But that's only half the battle, because now the lender turns their microscope to an entirely different part of your financial life: your assets. Where is the money for the down payment and closing costs actually coming from? Lenders will scrutinize every single dollar in your bank account with a forensic intensity, and one wrong move, one undocumented deposit, can derail everything. We'll uncover the secrets of asset verification next. This is where the dream meets the harsh, fluorescent light of the underwriter's desk. Welcome to what I call the financial colonoscopy of your life. It's the part of the process that trips up more qualified buyers than almost any other. Asset verification. It sounds simple, right? You just show them your bank statements. But it's not about showing them you have the money. It's about proving where every single penny came from. The lender isn't just your banker. At this stage, they're a financial detective, and your life savings are the crime scene. Why this intense scrutiny? 2 big reasons. First, they need to ensure you have enough liquid cash to cover your down payment and closing costs without draining your accounts to zero. They want to see that you'll have reserves left over after the transaction closes, a financial cushion in case life happens. They call this post-closing liquidity, and it's a major indicator of your ability to handle homeownership. But the second reason is the one that causes all the headaches. It's about federal law. Thanks to regulations like the Patriot Act and various anti-money laundering laws, lenders are legally required to source the funds you're using. They have to prove to the government that your down payment didn't just magically appear from an illicit source. This means every deposit is a suspect, every withdrawal a potential motive. So what are they looking for? They'll typically ask for the last 2 months or 60 days of statements for every single asset account you have. And I mean every account. Your primary checking account, your high-yield savings account, that random account you opened 10 years ago to get a free toaster and still has $87 in it. They want it all. They'll also look at investment accounts, your brokerage account with stocks and mutual funds, and your retirement accounts, your 401k, your IRA, your Roth IRA. For each of these, they are conducting a meticulous audit. Let's start with the basics, your checking and savings accounts. When the underwriter gets your statements, they're not just looking at the final balance. They are reading it line by line. They're looking for what they call large undocumented deposits. What's a large deposit? There's no single magic number, but it's generally any non-payroll deposit that's a significant percentage of your monthly income. $100 from your friend paying you back for pizza? Probably fine. But a $5,000 cash deposit? That's a siren blaring 5-alarm fire for an underwriter. And this brings us to the number 1 killer of mortgage applications: mattress money. Let's say you've been saving cash for years, stashing it in a safe at home. You've saved up $10,000. The week before you apply for a mortgage, you take that cash and deposit it into your checking account. To you, that's your hard-earned money. To an underwriter, that's $10,000 of mysterious, unsourced, and therefore unusable funds. You cannot prove where it came from. It could have been a gift, a loan from a friend, or proceeds from illegal activity. They have no idea, and because they can't document its source, they cannot count it toward your closing costs. In their eyes, that money simply doesn't exist. Mattress money is mortgage poison. The same rule applies to well-intentioned gifts from family. Let's say your parents want to give you $20,000 to help with the down payment. This is incredibly common, but you cannot just have them wire the money into your account. That wire transfer will show up as a large, unsourced deposit, and the underwriter will flag it immediately. The proper way to handle this is with a gift letter. This is a formal document where the person giving you the money signs a letter stating that the funds are a true gift, not a loan, and that they have no expectation of being paid back. They will also have to provide a bank statement showing the funds leaving their account. It creates a clean, unbroken paper trail that proves the money's origin. Without that paper trail, that $20,000 is worthless for your application. The paper trail is king. And it's not just cash. Let's talk about the modern world.
Venmo, Zelle, PayPal.
Say you went on a bachelor party trip and 10 of your friends each Venmo you $200 to pay you back. That's $2,000 in deposits over a few days. The underwriter will see these and demand an explanation for every single one. You'll have to write letters of explanation, provide screenshots, and document the reason for each transfer. It's a massive headache. The rule of thumb is this. For the 2 to 3 months leading up to and during your mortgage application, do not deposit any cash, and be prepared to explain every single non-payroll deposit that comes into your accounts. Now let's move on to investment and retirement accounts. Many people plan to use funds from a 401k or sell some stock to fund their down payment. This is perfectly acceptable, but again, it requires a flawless paper trail. If you're selling stock, the lender will need to see the brokerage statement showing your ownership of the shares, the trade confirmation showing the sale, and the bank statement showing the proceeds landing in your account. Every step must be documented. You can't just sell $20,000 in stock and have it appear in your checking account. They need to trace its entire journey. Using your 401k is another popular option, but it comes with its own set of landmines. You generally have two options: a hardship withdrawal or a 401k loan. A withdrawal is often taxed heavily and comes with early withdrawal penalties, so most people opt for a loan. They think, it's my money, I'm just borrowing from myself. But a lender sees it differently. When you take a loan against your 401k, that loan repayment becomes a new monthly debt. And that new monthly payment gets added to your debt-to-income ratio. Imagine this scenario. Your DTI is at 42%, just under the 43% limit for your loan program. You're approved. Then, you tell the lender you're taking a $10,000 401k loan for closing costs. The lender calculates the new monthly payment for that loan. Let's say it's $200 a month. They add that to your monthly debts. Suddenly, your DTI jumps from 42% to 44%. Your loan is now denied. You took a loan to help you buy the house, and in doing so, you just disqualified yourself from buying the house. The brutal irony is devastating. You must discuss any plans to use retirement funds with your loan officer from day one, so they can factor that new payment into your initial calculations. The single most important piece of advice I can give you is this: source everything. Think like an auditor. If money moved from one account to another, show the statement where it left and the statement where it arrived. If you sold an asset, show the proof of ownership and the proof of sale. And when you provide these statements, you must provide every single page. Even the blank page at the end that says, "This page intentionally left blank." I'm not kidding. Underwriters are required to review the full, unaltered document. If you submit a 7-page statement but only send them pages 1 through 6, they will reject it and kick it back, delaying your closing. There is one powerful strategy to avoid all of this scrutiny: seasoning your funds. Any money that has been sitting in your account for more than 2 bank statement cycles, typically 60 to 90 days, is considered seasoned. The lender doesn't care where seasoned money came from because it's been in your possession long enough that its origin is no longer relevant under their guidelines. So if your parents want to give you that $20,000 gift, the absolute best way to do it is to have them give it to you 3 months before you even start looking for a house. You deposit it, get the gift letter, and then you just wait. By the time you apply for your mortgage, that money will have appeared on 2 or 3 of your bank statements. It's now part of your established financial history. It's seasoned, and the underwriter won't ask a single question about it. Early planning is the ultimate mortgage hack. So you've meticulously documented every dollar. You've created a paper trail so clean it squeaks. You've proven you have the assets, and you've proven they come from legitimate sources. You've passed the financial colonoscopy. You've shown the lender you have the skin in the game. But that's only half the battle, because having your own money is one thing. Being trusted with someone else's is another thing entirely. Now, we have to move from the microscope to the telescope, looking back at your entire history of borrowing money. Your entire financial reputation is about to be condensed into a single 3-digit number that holds immense, almost terrifying power over your future. Your credit score. And the secrets hidden within that score, and the report it's based on, can make or break your American dream. We're diving into the cryptic world of credit reports. Next, this 3-digit number. This ghost in the machine of your financial life isn't just a number. It's a story. Your story. And before a lender gives you hundreds of thousands of dollars, they want to read every single chapter. The credit report is the book, and the score is just the summary on the back cover. And right now, we're opening that book to page 1. Think of it this way. There are 3 great scribes in the United States, constantly watching and recording your financial deeds. Their names are Experian, Equifax, and TransUnion. They don't collaborate, but they all write their own version of your financial biography. A mortgage lender won't just read one. They'll pull all 3, merge them into something called a tri-merge report, and look for the median score. Not the average, the middle one. If your scores are 720, 740, and 780, your qualifying score is 740. That's the number they work with. So what are these scribes actually writing about you? Your report is broken down into a few critical sections. First, the easy part, your personal information. Name, address, social security number. Seems simple, but an error here. A misspelled name and old address you don't recognize is the first red flag. It can link you to someone else's debt or signal potential fraud. You have to check this. It's the title page of your story. It better be right. Next, and this is the heart of the report, is your credit account history or trade lines. This is a detailed log of every line of credit you've ever had. Your credit cards, car loans, student loans, and yes, any previous mortgages. Each entry is a mini-story in itself. It shows the date you opened the account, your credit limit or loan amount, the current balance, and most importantly, your payment history for the last 7 to 10 years. It's a grid of little boxes, each one representing a month. A green check mark means you paid on time. A yellow triangle means you were 30 days late. An orange square, 60 days. A red octagon, 90 days or more. To an underwriter, this isn't just a grid. It's a measure of your character. It's a promise you either kept or broke month after month. Within this section, they're looking at 2 kinds of debt. Revolving debt, like credit cards, is a measure of your discipline. It's a line of trust a bank extends to you. Are you constantly maxing it out, living on the edge? Or do you use it sparingly and pay it off? Then there's installment debt, like a car loan. This is a fixed journey with a clear end date. Did you complete the journey as promised? Seeing a history of successfully paid off installment loans tells a lender you know how to handle a long-term commitment. Sound familiar? A mortgage is the ultimate installment loan. The third section is credit inquiries. This is where the lender sees who else has been reading your story. There are 2 types, soft inquiries and hard inquiries. A soft pull happens when you check your own credit, or when a company pre-screens you for a credit card offer. These are invisible to lenders. They don't affect your score. You can check your own credit 1,000 times a day. It won't hurt you. A hard inquiry is different. This is the official knock on the door. It happens when you formally apply for new credit, a credit card, a car loan, a mortgage. 1 or 2 are no big deal. But a flurry of hard inquiries in a short period of time? To a lender, that's a siren. It looks like desperation. It looks like you're trying to get cash from anywhere you can, which is a massive indicator of financial distress. The only exception is rate shopping for a mortgage or auto loan. The scoring models are smart enough to know that if you have multiple mortgage inquiries within a 30 to 45-day window, you're not trying to buy 5 houses, you're just looking for the best deal on one. Finally, there's the section that can be a death sentence, public records and collections. This is where the truly damaging stuff lives. Bankruptcies, foreclosures, tax liens, civil judgments. These are the financial world's scarlet letters. They show a history of not just being late but of complete financial collapse. A collection account where you owed a debt and the original creditor gave up and sold it to a collection agency for pennies on the dollar is another huge red flag. It tells the underwriter you didn't just miss a payment. You walked away from the debt entirely. All of this data, every late payment, every maxed out card, every new application, is fed into a secret, complex algorithm that spits out your FICO score. While the exact formula is a proprietary secret, FICO has told us the ingredients. And understanding these ingredients is the key to mastering the system. 35% of your score, the biggest piece of the pie, is your payment history. Period. Nothing matters more than paying your bills on time every single time. One 30-day late payment can drop an excellent score by 100 points and stays on your report for 7 years. It's the cardinal sin. The next 30% is amounts owed. But what it really means is credit utilization. This is specific to your revolving debt, your credit cards. It's the ratio of how much you owe versus your total credit limit. If you have a $10,000 limit and a $9,000 balance, your utilization is 90%. You are screaming financial risk. You're running on fumes. If your balance is $1,000, you're at 10%. You look controlled, responsible. The golden rule is to keep your utilization below 30%. The pro-level rule? Keep it under 10%. People with the highest scores, the 800-plus club, often have utilization rates of less than 7%. 15% of your score is the length of your credit history. Age is your friend here. An account you opened 15 years ago is a powerful asset. It shows a long track record of responsible behavior. This is why you should almost never close your oldest credit card. Even if you don't use it, cutting it up is fine, but closing the account shortens your credit history and can drop your score. 10% is your credit mix. Lenders like to see that you can successfully manage different types of credit: a credit card, a retail card, a car loan. It shows you're a versatile financial athlete. And the final 10% is new credit. This goes back to those hard inquiries. Opening several new accounts in a short time makes you look risky. It lowers the average age of your accounts and, as we said, can signal desperation. So, the underwriter isn't just glancing at your 740 score and moving on. They are reading the story that produced that 740. They see that you missed a car payment 2 years ago. They see you maxed out your Visa right after Christmas last year. They see you applied for a department store card last month. They are a detective looking for patterns. They're asking one fundamental question. If we lend this person $300,000, what does their past behavior tell us about their likelihood of paying us back for the next 30 years? Now, what if the story they're reading is wrong? What if there's a collection account on there from a medical bill you never even received? What if it shows you were late on a student loan that was in deferment? The system is not perfect. The scribes, Equifax, Experian, TransUnion make mistakes. It is your right, and your absolute responsibility, to become the editor of your own story. By law, you are entitled to a free copy of your credit report from all 3 bureaus once a year. The only place you should go to get this is the official, government-mandated site, annualcreditreport.com, not the ones you see in commercials with the catchy jingles, the official one. Get your reports. Print them out. Go through them with the red pen line by line. If you find an error, you dispute it. You file a dispute directly with the bureau reporting the error. You provide your evidence, a canceled check, a letter from the lender. They are legally obligated to investigate within 30 days. If the creditor can't prove the debt is valid and accurate, the bureau must remove it. Gone. Wiped from the page. This single act can raise your score by dozens, sometimes even over 100 points. It can be the difference between a denial and an approval, the difference between a high interest rate and a great one. You have to be your own advocate. Because once that report is clean, accurate, and tells the best possible version of your financial story, you've passed one of the most critical tests. You've proven you're a reliable character. You've shown them your past is solid. But a great history isn't enough. It's only half the equation. The lender now knows who you were. Now they need to know who you are. They need to know if you have the financial horsepower right now to carry the weight of this new debt. You've shown them your discipline. Now you have to show them your income. Every paycheck, every side hustle, every dollar that flows into your life is about to be placed under a microscope. We're leaving the past behind and stepping into the harsh, documented reality of your present-day earning power. And this is where the game fundamentally changes. Up until now, we've been archaeologists, digging through the ruins of your financial past, examining your credit report like ancient text. But now we become forensic accountants. The question is no longer, how well did you handle money? The question is, how much money do you actually have coming in, right now? This isn't about promises or potential. It's about cold, hard, verifiable proof. Your lender needs to build a fortress of certainty around one single idea: your ability to repay this massive loan month after month for 30 years. Your income isn't just a number on a form. It's the foundation of that entire fortress. If it's weak or cracked or built on sand, the whole structure collapses. So they will test it. They will stress it. They will verify it from every conceivable angle. Let's start with the most straightforward path. The W-2 employee. You work for a company, you get a regular paycheck. Seems simple, right? Not so fast. The first thing they'll ask for are your most recent pay stubs, usually covering the last 30 days. They aren't just looking at the big number at the top. They are dissecting it. They're looking for consistency. Is your year-to-date income on track with what you claim you make annually? Are there any large, unusual deductions? Is your overtime consistent? Or was it a one-time fluke? This is a critical point. Lenders hate flukes. They hate one-offs. They're trying to project your income for the next 360 months. A single massive overtime check from that one crazy project last month doesn't impress them. What impresses them is a pattern. If you've consistently earned overtime for the last 2 years, they might be willing to count a portion of it. If not, to them it doesn't exist. It's phantom income. Next, they'll want your W-2 forms for the last 2 years. This is the official, IRS stamped proof of your earnings. This is how they confirm the story your pay stubs are telling. Does your income show stability? Or better yet, does it show growth? A steady climb in your W-2s from one year to the next is a beautiful sight to an underwriter. It tells a story of career progression and reliability. A significant drop, however, raises a massive red flag. You'll need a very good explanation, like a documented leave of absence or a career change that you can prove is now stable. Finally, they'll likely perform a verification of employment, or a VOE. This is where they call your boss. Well, usually HR. They will send a form directly to your employer to confirm your start date, your position, your salary, and most importantly, your probability of continued employment. That last part is key. They want to know you're not a temporary contractor, or that your position isn't about to be eliminated. They need to know the money faucet is likely to stay on. Now, for everyone else. For the freelancers, the gig workers, the small business owners, the 1099 contractors. Welcome to the big leagues of financial scrutiny. If the W-2 employee is taking a written test, you are preparing for a full doctoral dissertation defense. You don't have an employer to vouch for you. You have to vouch for yourself, and your evidence has to be irrefutable. Your single most important document is not a pay stub. It is your federal tax returns. And you will need, at a minimum, the last 2 years of signed filed returns, including all schedules. Especially Schedule C, which details your profit and loss. This is your Bible. The lender doesn't care about your gross revenue. They don't care that you billed $100,000 last year. They care about what was left after all your expenses. They are lending to your net income, not your ego. And here is the brutal truth that trips up so many entrepreneurs. The same tax deductions you used to brilliantly lower your tax bill are now working against you. Every legitimate business expense you wrote off, your home office, your mileage, your supplies, that new laptop, reduced your taxable income. And in the eyes of a mortgage lender, it reduced your qualifying income. You can't have it both ways. You can't tell the IRS you made $40,000 to save on taxes, and then turn around and tell the bank you made $100,000 to get a loan. The bank will always believe the IRS. They will take your net income from the last 2 years and, in most cases, they will average it. Let that sink in. If you made $50,000 2 years ago and $100,000 this past year, an amazing year of growth for you. The bank doesn't see a $100,000 income. They see a $75,000 income. They average the two. Worse, if you made $100,000 2 years ago and only $50,000 this past year, they will see that as a declining business and will likely use the lower, more recent number, or they might deny you altogether. The trend is everything. You'll also need to provide a year-to-date profit and loss statement, or a P&L. This shows them how your business is performing in the current, unfiled tax year. And you'll need business bank statements, often for the last several months, to prove that the income you're claiming on your P&L is actually flowing into your accounts. They are cross-referencing everything. The tax return, the P&L, the bank statements, it all has to tell the same consistent story of a stable, predictable business. But what about other kinds of income? It's not always a simple paycheck or a business profit. Let's say you get a significant annual bonus. You can't just add that to your salary. You'll need to prove you've received it consistently for at least 2 years, and your employer will have to state that it's likely to continue. Again, they're looking for a pattern, not a lottery win. The same goes for commission-based income. If your pay is highly variable, they will need 2 years of tax returns and W-2s to calculate a stable, predictable average. They need to smooth out the peaks and valleys to find a reliable baseline they can count on. Do you have a rental property? Great. You can use that income to help you qualify. But don't expect to use 100% of the rent you collect. Lenders will typically only count 75% of the gross monthly rent. Why? Because they know you have vacancies, repairs, and management costs. That 25% buffer is for the realities of being a landlord. And to prove this income, you'll need copies of the current lease agreement and tax returns showing the income for the last 2 years, if you've owned it that long. What about child support or alimony? Yes, this can absolutely be used as qualifying income, but the documentation is specific. You'll need a copy of the divorce decree or legal agreement spelling out the terms. And you'll need proof that you've been receiving consistent, timely payments for at least the last 6 to 12 months. On top of that, the agreement must state that the payments will continue for at least 3 more years from the date of your mortgage application. Even retirement income, like pensions or Social Security, needs to be documented with award letters and proof of deposit into your bank account. The theme here is inescapable. If you claim it, you must prove it. And you must prove that it's stable and likely to continue. The person reviewing all of this, the underwriter, is essentially building a legal and financial case for why you are a safe bet. Every document you provide is a piece of evidence. A pay stub is Exhibit A. A tax return is Exhibit B. A missing document or an inconsistency between documents creates doubt. And in the world of underwriting, doubt is the enemy. Your job is to provide so much clear, consistent, and overwhelming evidence of your earning power that there is simply no room for doubt left. You've shown them your history with credit. Now you've laid bare the raw, documented power of your income. But there's one final piece to this puzzle. The lender knows what you've done, they know what you earn, but now they need to answer the most critical question of all. What do you have and what do you owe? We're about to put your income on a scale and weigh it against every single one of your debts, to arrive at the single most important number in your entire application. That number is your debt-to-income ratio, or DTI. And if the mortgage application were a video game, DTI would be the final boss. It's the ultimate stress test of your financial life. A single percentage that tells a lender more about your ability to handle a mortgage than almost any other factor. Get this right and the path to homeownership opens up. Get it wrong and you'll hit a brick wall no matter how good your credit score is. So what is it? In the simplest terms, your DTI is the percentage of your gross monthly income that goes towards paying your monthly debt obligations. It's a snapshot. It shows a lender, before they hand you hundreds of thousands of dollars, just how much of your paycheck is already spoken for. Think of it like this. If your income is a pie, DTI shows how much of that pie is already promised to other people before you've even had a chance to pay for groceries, gas, or a night at the movies. Lenders want to see a pie with plenty of slices left over. To calculate it, we need to focus on 2 things, the D for debt and the I for income. Let's start with the debt because this is where a lot of people get tripped up. The lender is going to tally up every single one of your recurring monthly debt payments that appear on your credit report, plus a few that don't. First and most importantly, they add in the proposed new housing payment. This is critical. They don't just look at your existing debts. They add the very mortgage you're applying for into the calculation. This includes the principal and interest on the loan, plus an estimate for your property taxes, your homeowner's insurance, and any homeowners association or condo fees. We call this PITI. So right from the start, the biggest debt of all, the house itself, is part of the equation. Next, they go line by line through your credit report. That car loan you have? They'll take the full monthly payment. Those credit cards? They don't care if you pay the balance in full every month. For the DTI calculation, they will use the minimum monthly payment listed on your credit report for every single card. If a minimum payment isn't listed, they'll typically use 5% of the outstanding balance, which can be a huge shock to people. Then come student loans. This is a minefield. Even if your loans are in deferment or forbearance and you aren't currently making payments, the lender has to account for a future payment. The rules vary by loan type, but they will typically use either the actual documented payment from an income-based repayment plan, or they'll calculate a hypothetical payment, often using a formula like 0.5% or 1% of the total loan balance as the monthly payment. So a $100,000 student loan balance, even with 0 payments being made today, could be counted as a $500 or even a $1,000 monthly debt in your DTI calculation. Finally, they add in any other installment loans, personal loans, furniture loans, you name it, and any court-ordered payments like alimony or child support. What they don't include are your day-to-day living expenses. Your utility bills, your cell phone plan, your car insurance, your Netflix subscription, none of that counts towards your DTI. It's strictly about payments to other lenders and creditors. Now for the other side of the scale, the I for income. This is the total verifiable gross monthly income we spent so much time documenting in the last section. Gross, not net. This is your income before any taxes, 401k contributions, or health insurance premiums are taken out. For W-2 employees, it's your salary divided by 12. For self-employed individuals, it's that 2-year average net income from your tax returns, divided by 24. The key is that it has to be stable, reliable, and likely to continue. So let's put it all together with an example. Let's say you make a gross income of $7,000 a month. Your proposed new mortgage payment, your PITI, is calculated to be $2,500. You have a car payment of $500, student loan payments of $300, and the combined minimum payments on your credit cards are $100. First, we add up all your monthly debts. $2,500 for the house, plus $500 for the car, plus $300 for student loans, plus $100 for credit cards. Your total monthly debt obligation, for the purpose of this calculation, is $3,400. Now we take that total debt and divide it by your gross monthly income. So $3,400 divided by $7,000. The result is 0.485, or 48.5%. That is your debt-to-income ratio. It means that for every dollar you earn before taxes, almost 49 cents is already committed to paying back your debts, including your new home. From a lender's perspective, this number is a risk meter. A low DTI suggests you have plenty of cash flow to handle your obligations and absorb unexpected financial shocks. A high DTI suggests you're stretched thin, living paycheck to paycheck, and that a single unexpected expense could put you on the path to missing a payment. So what are the magic numbers? What DTI will get you approved? This depends heavily on the type of loan you're getting. For a conventional loan, the kind backed by Fannie Mae and Freddie Mac, the ideal target is a DTI of 43% or lower. This is the sweet spot. However, automated underwriting systems can often approve borrowers with a DTI up to 50% if they have strong compensating factors. What are those? A stellar credit score, say 740 or higher, a large down payment, maybe 20% or more, or significant cash reserves left over after closing. These things show the lender you are financially responsible and have a cushion, which makes them more comfortable with a higher ratio. For an FHA loan, the guidelines are more generous. This is one of their biggest selling points. FHA loans can often be approved with a DTI as high as 56.9%. It sounds crazy, but it's designed to help buyers with more modest incomes get into a home. The trade-off is that you'll be paying for mortgage insurance for a very long time. For a VA loan, for our veterans and active duty service members, the guidelines are different yet again. Officially, the VA doesn't have a maximum DTI limit. However, most lenders impose their own internal limit, often around 41%. But the VA looks at something else that's unique: residual income. They calculate how much money you have left over each month after paying all your major debts and estimated living expenses. As long as you meet their minimum residual income threshold for your family size and region, they may approve the loan even with a higher DTI. And for a USDA loan, for homes in eligible rural areas, the limits are the strictest. They typically cap your DTI at 41%. So what do you do if your DTI is too high? Don't panic. You have options. You can either increase the I or decrease the D. Increasing your income is the harder path. It might mean waiting for a raise or documenting a side hustle for 2 years. Decreasing your debt is often faster. The quickest way to make a big impact is to pay off a small loan completely. Getting rid of a $200 a month personal loan, for example, frees up that $200 in the DTI calculation, which could be enough to qualify for an extra $40,000 or $50,000 on your mortgage. You could also look at paying down credit card balances to reduce the minimum payments. The goal isn't necessarily to become debt-free overnight, but to strategically lower your total monthly obligations. This entire process of documenting income, verifying assets, and calculating your DTI is all leading to one place. It's about building a complete bulletproof file. A story of your financial life, told through pay stubs, tax returns, and bank statements. And once that story is complete, your loan officer will do something that marks the single most significant transition in the entire mortgage process. They will submit your file to the final judge and jury, the one person who holds the ultimate power to say yes or no. They are sending it to the underwriter. And what happens inside that underwriting black box is where the dream of homeownership becomes a reality, or gets put on hold. The underwriter. The name itself sounds intimidating, like a final boss in a video game, but they aren't a faceless bureaucrat looking for reasons to say no. Think of them less as a judge and more as a detective or a risk analyst for the bank. Their one and only job is to look at your entire loan file. Every pay stub, every bank statement, every line item on your application, and answer a single multi-million-dollar question for the lender. If we give this person this much money, what is the statistical probability we will get it back? That's it. They are the ultimate guardian of the lender's investment. To answer that question, they meticulously verify every single piece of information your loan officer collected. Their mantra is simple: prove it. You say you make $100,000 a year? Prove it with W-2s and tax returns. You say you have $20,000 for a down payment? Prove it with bank statements. They are connecting the dots of your financial story, ensuring it's not a work of fiction. They primarily focus on what the industry calls the 3 C's of credit: capacity, credit, and collateral. First, capacity. This is a direct measure of your ability to repay the loan. The underwriter is going to zero in on your debt-to-income ratio, or DTI, which we've talked about. They'll recalculate it themselves, verifying every income source and every debt payment listed on your credit report. They're looking for stability. Have you been at your job for at least 2 years? Is your income consistent? Or does it fluctuate wildly? If you're self-employed, they'll scrutinize your tax returns for the past 2 years to see a stable, predictable pattern of earnings. They're also looking at your cash reserves, the money you'll have left over after you pay your down payment and closing costs. Do you have enough of a cushion, say 2 to 6 months of mortgage payments, to weather a financial storm like a job loss or an unexpected medical bill? Capacity isn't just about affording the mortgage today. It's about your ability to afford it for the foreseeable future. Second, credit. The underwriter dives deep into your credit report, looking far beyond just the 3-digit score. That score is just a summary. They're reading the full story. They analyze your payment history. Do you pay your bills on time every time? A single 30-day late payment on a car loan 2 years ago might be overlooked. A pattern of late payments on multiple credit cards last year? That's a major red flag. They look at how you use credit. Are your credit cards maxed out, suggesting you're living beyond your means? Or do you keep your balances low, showing responsible management? They'll scrutinize any public records, bankruptcies, foreclosures, or judgments. If you have them, they'll require a detailed letter of explanation describing the circumstances and how you've since re-established good credit. Every blemish on your credit report needs to be explained and documented, because to an underwriter, past behavior is the best predictor of future performance. And third, the most important C of all when it comes to the property itself: collateral. This is the house. The lender is giving you hundreds of thousands of dollars, and the house is the physical asset securing that loan. If you stop making payments, they take the house. So the underwriter needs to be absolutely certain that the house is worth what you're paying for it. How do they do that? Through the appraisal. The lender will order an independent appraisal from a licensed professional. This appraiser will visit the property, measure it, take photos, and assess its condition. But their main job is to determine the fair market value. They do this by finding comparable sales, or comps, recently sold homes in the same neighborhood that are as similar as possible to your house in size, age, condition, and features. They'll make adjustments. If your house has a brand new kitchen but the comp has a dated one, they'll add value to your property. If a comp has a swimming pool and yours doesn't, they'll subtract value. After this detailed analysis, they issue an official appraisal report with a final value. This is one of the most nerve-wracking moments in the entire process. The appraisal must come in at or above the purchase price. If you agreed to buy a house for $400,000, the appraisal must value it at $400,000 or more. If it does, everyone breathes a sigh of relief. But what if it comes in low? What if you agreed to pay $400,000, but the appraiser says it's only worth $380,000? This creates what's called an appraisal gap. The bank will only lend you money based on the lower of the two values, the purchase price or the appraised value. In this case, they'll only finance a loan based on a $380,000 value. You now have a $20,000 shortfall. Here you have a few options. You can try to renegotiate the price with the seller. You can pay the $20,000 difference in cash out of your own pocket. You can challenge the appraisal if there are legitimate errors. Or, if your contract allows, you can walk away from the deal entirely. Once the underwriter has stress-tested your capacity, your credit, and the home's collateral, they will issue a decision. There are 3 possible outcomes. The first, and least common on the first go-around, is a full, unconditional approval. This means your file was perfect, everything checked out, the appraisal is solid, and you are good to go. The second, and by far the most common outcome, is a conditional approval. This is not a denial. Let me repeat that. Conditional approval is not a no. It's a yes if the underwriter has largely approved your loan, but they have a list of outstanding conditions that need to be met before they can give the final sign-off. These are typically requests for more documentation or clarification. For example, provide a letter of explanation for the large, non-payroll deposit in your checking account. Or, provide the most recent statement for your 401k to verify assets. Or even, pay off this specific credit card and provide proof the account is closed. Your loan officer will work with you to gather these final items, send them back to the underwriter, and clear the conditions. This is a normal part of the process, so don't panic when you see it. The third outcome is the one nobody wants, a denial. If the underwriter finds a fundamental issue, your DTI is just too high, a recent major credit problem, or unverifiable income, they may deny the loan. While it's devastating, it is not the end of your homeownership journey. The lender is required by law to provide you with a written explanation for the denial. This is not a rejection of you as a person. It's a statement of financial fact based on their guidelines. That letter is your roadmap. Tells you exactly what you need to fix. Maybe you need to pay down debt to lower your DTI. Maybe you need another year of consistent income from your new business. Or maybe you just need to wait 6 more months for a credit issue to season. A denial is not a never. It's a not right now. Once all conditions are met and the underwriter is satisfied, they will issue the 3 most beautiful words in the mortgage world: clear to close. This is the green light, the finish line. It means the underwriter has officially signed off, the lender has committed the funds, and all the paperwork can be sent to the title company or closing attorney to prepare for your closing day. And just like that, the marathon you started weeks or even months ago is over. You've navigated the labyrinth. You've gone from a curious house hunter to a pre-approved buyer, from making an offer to surviving the inspection, from assembling a mountain of paperwork to satisfying the final demands of the underwriter. You've decoded the entire process. You now understand the language of lenders, the rhythm of real estate, and the logic behind every request and every form. You've transformed one of the most complex and intimidating financial transactions of your life into a manageable, step-by-step journey. This knowledge doesn't just get you a key. It gives you confidence, control, and the power to make smart decisions for your future. The mortgage application is no longer a black box. It's a roadmap. And now you hold that map in your hands. Go find your home.